I know from abundant research that if you do nothing other than include women in your solutions, you achieve two things that really matter. One is that as an investor, you get a higher return. But then on the economy side, it's actually estimated that if women have the same access to capital as men, just in this space, we'd have a 6% increase in GDP. There is no other single factor that could increase growth of our economy in that way.
Women on average flee a violent perpetrator on 7 occasions and return before they finally break free. By providing an appropriate safe house, women left on the first occasion and never returned to the violent perpetrator. Since that time we met that organisation in 2017, with our funding they have bought somewhere between 80 and 100 houses, which they now help women flee domestic abuse on a regular basis.
We have a retail investor base. That's our theory of change. If we can create impact funds, financial institutions in communities where there's not good access to capital, if we can capitalize them, then that's a sustainable, reliable capital source for those businesses in place.
We always thought about, how can we invest in businesses that are helping to lift millions of people out of poverty? And if you want to do that, you need to think about the markets where there are large numbers of low-income people. And for us, there's kind of 3 clusters. There's Southeast Asia, and then you have South Asia, and then finally Sub-Saharan Africa. We're just very intentional about these handful of large low-income markets that we invest in across Asia.
You and your company's mission, I might describe as being focused more in the social impact dimension than say something like environmental or climate change dimension. And that's because Astia's raison d'etre and focus is on trying to solve, I think, a singular issue, which is that the percentage of VC investment into companies with women in leadership and equity positions, and specifically in the startup and private equity world, is terribly low compared to the percentage of VC investment going into companies with men in leadership positions. And I'm approaching our discussion with a level of discomfort that I don't normally feel. I usually have some experience in my career that allows me some anecdotal experiences when I'm speaking about bonds or private equities or microfinance and so forth. In this particular case, I'm feeling strangely out of place. I'm aware of some of these issues that you've already alluded to. My wife is a senior financial executive, and she's been quite influential, having co-founded the Women's Leadership Network some years back at her company, which is a public company headquartered in the Valley. So we've had more than a few conversations about the issues that women face in navigating the corporate ladder. But that's very different than having firsthand experience myself. So Sharon, be easy on me today. You never know, I might find out I'm part of the problem, and maybe my wife might agree. But I'm a father of a daughter and a stepfather of my wife's daughter, so I'm obviously very interested in this subject and I want to be an ally. So let's start with an overview of Astia, what your mission is and what's your theory of change.
Yeah, so I really appreciate the preamble because it helps me. Let's start at the 30,000. Actually, we're going to go up to the 60,000 foot level and go a little bit into the thin air to keep you really uncomfortable, get your heart rate really up there. But why this matters. Let's start with the why this matters. So I don't see this as a social raison d'etre. Don't get me wrong. I think there is one. There is absolutely a social case to be made. But I actually see this as a real economic challenge. Once again, I told you I'm an economist in my background. All net new jobs in the last 30 years were created by companies that were venture-backed. Companies like Amazon, Walmart, they actually shed jobs ultimately, right? Once you've hit that level of success, they're job killers rather than job growers. Job growth happens out of the innovation economy.
Okay.
Number 2, life's full of great challenges, but it's more now than ever. We have a pandemic, an economic crisis, a climate crisis, feeding a growing population. These are real world, really difficult challenges that will be addressed through innovation. The solutions for them might not even exist yet today, but they're addressed through innovation. it is my belief as an economist that by excluding a substantial percentage of the population, and I don't mean just women, I also mean people of color. Interestingly, they're horribly underfunded. Well, if we leave the space of innovation to white men only, and white men specifically of a specific pedigree, Wharton, Harvard, or Stanford, we're not going to get as robust a set of solutions because the problem set will be misdefined, because their own experience won't allow them to push the boundaries of the problem. There's good research that shows this, that to get to true innovation, my favorite research on this is MIT's Professor Malone's research on inclusive teams and their ability to innovate and how they out-innovate even top performing. If you take super intelligent, homogeneous teams, they are always beaten or outperformed by heterogeneous teams, regardless of intellect. You know, as an economist, this matters because we need real solutions, right? We don't need tinkering at the edges. This is an all hands on deck moment to get to real solutions. So I actually don't see this as a social problem. Equally, I know from abundant research that if you do nothing other than include women in your solutions, you achieve two things that really matter. One is that as an investor, you get a higher return. So just with my investor lens, I want inclusive teams because the returns are higher. But then on the economy side, it's actually estimated that if women have the same access to capital as men, just in this space, I don't mean broadly in the economy, I just mean in the venture economy, we'd have a 6% increase in GDP. There is no other single factor that could increase growth of our economy in that way.
Where does that come from, this statistic?
I used to be on Hillary Clinton's, when she was Secretary of State. I was on her advisory body for entrepreneurship. And they did a phenomenal job of measuring the opportunity and impact to GDP and the potential of women. And that was right out of their commission and their work. Babson has also repeated the study and done a phenomenal job of measuring the opportunity as it relates to this part of the economy. So for me, it's about efficiencies of markets. It's about return on capital. It's all of the stuff that you actually are very comfortable with. I just happen to know that when you overlay gender, especially on this part of the economy, because women are so profoundly underrepresented, the dirty little trick is it's actually really easy. If you did nothing other than gender, you impact all of these other things. The other interesting thing is the UN found that as it relates to ESG goals, the environmental sustainability goals, if you do nothing other than gender, you actually end up addressing all of the other goals. Goal number 7 is gender inclusion. If you do no other goal, if you just do that one, you'll hit your economic targets, you'll hit your environmental, your health, your food, you hit all of the other ESG goals. So the context of why Astia for me is not the social one. Don't get me wrong, I'm a woman, I care deeply about that. That's different. My motivations are actually as it relates to the opportunity as an investor. I've been investing for 20 years, and I put my performance up against anyone's in Silicon Valley. And by the way, I've been called arrogant for saying that. I say that with all the humility. I don't create the results; the entrepreneurs do. So I don't want you to perceive that I'm being overly arrogant. I'm just stating the obvious. And then equally to the investor is the economic impact. It's massive. What could be done if we could simply trigger or unleash more venture into companies that included women?
What are the key stats that you cite? I think you've mentioned 2%.
A key statistic in venture capital to understand is, and let's remember, it punches above its weight. So one of the reasons we should care about it is it's a driver of the economy, disproportionate to the amount of capital it deploys. So because you're more comfortable with capital market or private equity numbers, venture numbers may look really small, but they punch well above their weight in impacting the economy. So we should care about them. But number one, venture capital, for the 20 years that Astia has existed, between 2 and 3% each year gets invested into women CEOs. And equally deplorable is that between 5 and 7% gets invested into teams that have women anywhere. The rest, 95% of venture capital is invested into all male, predominantly white teams.
So 2 to 3% of capital is invested in startups founded or led by women CEOs.
Women CEOs. I don't know if they founded them, but it's women CEOs.
Okay, yeah. And 5 to 7% would be companies that may or may not have a woman CEO, but have women on the leadership team, let's say.
Yeah, exactly.
Yeah. Right,
yeah.
Right.
And
Okay.
it's been true for the entire 20 years that Astia has existed. So this is sticky stuff. That's the important piece for you to understand too. At its height, we got up to 10% during the dot-com bubble. And then the second the bust happened, we went right back down. But the 10% was women on the team. Women CEOs has never gotten above 5%.
What is the problem here? What you said, it moved up to 10% and now it's back down.
Yeah. We should remember that it's bigger than venture, right? And this isn't a venture problem. It just happens to come to a head in venture because of how our economy works. Still today in the US and globally, men and women are in separate business networks. And this is just true. There's no way to deny it. And Scott, you used a word that I'm going to call you out on and challenge you to think about differently. You said that you want to be an ally. Yeah. I want you to be a business partner. Okay. I don't want you to be my ally. I want you to be my business partner. And what I mean by that is I want us to find a way to do a deal together. And that's hard. Mm-hmm. Yeah. It's really hard. There are a lot of barriers to that. Number one, most business transactions occur in what I'll call fairly intimate business settings. Boardrooms, that's very intimate. Offices, C-suites, that's equally intimate. Then you move it out into a social context, golf courses, interestingly intimate. The reason I call them intimate is because you're really only invited into those rooms. You can't self-nominate into those spaces. You're invited in. Historically, men ran business. And so they occupy those intimate spaces. And to get women into those intimate spaces is quite difficult. Venture capital. So it was founded by some great men and a few women, and those men conducted businesses in these intimate spaces, around boardrooms, out for a drink, and it was just more comfortable to invite other men in. Because socially, how do you explain to your wife that you and I are going out for a martini to talk about a deal? It's really difficult, but that's where the deal happens. Mm-hmm. And I'm not advocating that's where a deal should happen. I'm highlighting that's where it happens. You know, it's also why women aren't on boards, because you can't self-nominate yourself onto a board. Where it happens, the board's talking and they're talking about potentially expanding. They're going to hire a firm. They know this buddy, but this buddy is someone that they'll send that buddy into the firm to that buddy. They play golf with him every Saturday. He's really smart. He's also on the board of Apple. He's also on the board of da-da-da-da. Then they're done that. The measures of how you move into that intimate space have to do with who knows you, because they're going to talk about you when you're not in the room. That's a good thing. What they think about you from your experience. Do they understand your experience enough to translate it to someone else? And women tend to have unusual or less like men journeys, right? My own into venture isn't the classic journey. So it's harder for them to translate it. And then the third one, we should never underestimate the challenge of men and women doing business purely because of how it affects the home life, especially in private equity and venture, where deals are done in informal spaces. That's the best way I can describe it. It bumps up against social pressures. And we kept hearing this from male VCs. An example of some of the things we heard over our years, and this is without judgment, I think this is just the reality. This is social dynamics. We heard from men, I don't know, I wasn't able to really get to know her, so I don't know that I could trust her numbers. And then you ask why. Normally I'd take her out for a beer, but I didn't want to do that because, then she might think I'm hitting on her, and I didn't want to be hitting on her, so I didn't really get to know her. But investment, especially venture capital, is really personal. You got to trust the person. Trust flows very poorly across gender and race. Building that trust is essential to make the investment happen. The other things we heard is I didn't understand what she was saying. She was presenting this company to me. One of our largest exits, two of them actually, are in the space of women's reproductive health. One is a medical device for diagnosing ovarian cancer. The other one is a medical device for treating of hemorrhaging at childbirth. Yeah. When we took both of those companies up to VCs who are in the medical device space, right? So they know science, they know medical science. Some of the feedback we got was take the fallopian tubes off the slides. That's gross. I'll have to go home and ask my wife if this is a real need because I don't know. Isn't it a niche market because it only serves women? Now, these are all interesting questions, but the most interesting to me was the social construct behind the questions. That, wait, you have so few women in your life that you have to ask your wife? She's your reference point for business? But the truth is, yes, most of these men only work with other men. And this isn't about judging those men as individuals. This is the stuff in society. When you start a venture firm, you're putting in your own money, you're pulling in other people's money. It's a very trusted space, and you're going to choose people that make you comfortable. That's people just like you. So venture struggles not because it excludes women. It struggles because of its structure. Its structure reinforces all of the social dynamics that exist broadly out there for men and women in business. But it comes to a head because of how much of it is conducted in these intimate spaces. And it doesn't have governance. Most venture firms don't have board of directors. They don't have what I'll call process requirements. They certainly don't have reporting requirements. Most, when you talk to LPs, GPs rarely provide the reports that certainly publicly traded companies would require, but they raise hundreds of millions of dollars and don't have the reporting requirements commensurate with that kind of obligation. That's the fundamental issue. Venture is structured around really intimate spaces, and it's uncomfortable and difficult to bring in people who don't remind you of yourself.
Why don't we drill down on the social housing fund, maybe give an overview of that fund and the impact that you're targeting to achieve with that?
So this is very specific and easy to understand, I think, if I can explain it. Working with vulnerable people in the UK involves two things, typically. It involves providing them with the advice and support that they need to overcome an issue that they're facing. Maybe that they've left their violent partner, that they've come out of the foster system, they've come out of jail, they're living with a learning disability, whatever it might be. So part of the role of these organisations is to provide the support that's needed to help them overcome that. But another part of it is to ensure that they're living somewhere suitable and safe. Charities have been trying to deliver this dual kind of outcome, but they've had one hand slightly tied behind their back because they've been relying on external parties for the housing element. So they've maybe been relying on the council or housing associations or private rental sector to ensure that there were suitable properties available for their clients that would hopefully help their recovery or their transition or their life or their ongoing situation, but certainly not hurt the chances of developing a stable living situation. And what became clear to us as we were involved in this space was actually more often than not, housing options were really poor. They are either well-meaning but not suitable at one end of the spectrum, all the way down to unsuitable and frankly slightly scandalous in terms of the condition of some properties that existed in the private rental sector. Now, that's disappointing but not completely surprising, because there's no reason why the private rental sector in the UK, where the average number of properties owned by a private sector landlord is one, why that would be a body that could be relied upon for housing disadvantaged and vulnerable people. The market, for whatever reason, and there's a whole separate discussion about the housing market in the UK, has evolved to quite an unsatisfactory place. But what we were faced with was a situation where these charities that could do a great job with people were underperforming because they just could not access appropriate housing. And we, in our travels in trying to understand how we were going to make a positive impact on the world, discovered a group of charities that had taken their fate into their own hands and found ways to become their own landlord and either rent or buy properties and take control of housing stock and use those houses that they controlled and owned or controlled and leased to ensure that the interventions they were delivering were located in appropriate living accommodation. And what we saw was the just huge change in the level of outcomes that organisations that had access to those properties were able to achieve. And so we looked at the space and said, we need to have a fund that allows residential property to transfer from the commercial profit maximisation space into the charitable space so that it can be offered to clients alongside the support services that charities offer. So we were focused on providing that finance. Now, so that's philosophically what we're doing, practically what we're doing. If you're a charity, you probably can get a mortgage, and some of them do have mortgages. But because of the risk-averse nature of charities, we found that there was a limit to how far they were prepared to extend themselves to purchase this housing and to build these property portfolios. And what we understood over time was that the reason that was the case was because of the nature of a mortgage. And there were some certain factors about mortgages that they found off-putting. The requirement to come up with a deposit, the fact that they were exposed to house prices, the fact that they were exposed to voids and to government payments, and the fact that they could never really be sure, because of the fixed nature of mortgages, that they'd be able to cover the ongoing cost of these houses. So what we realised, given our experience of working with charities, was two things. One, that if we could find a way to share some of those risks or to pass some of those risks from the charities onto the investor base, that would enable them to consider taking on investment. And number two, because of the work we do with the investor base, and because we have been investors ourselves, we realised that the risks that the charities wanted to rid themselves of were actually things that in a great many cases investors were not going to be worried about. And in fact, actually, in some cases, we're actually positively trying to seek, i.e. exposure to government inflation assets that increase in value with inflation. And we spotted an opportunity to create a very simple structure that de-risked the proposition for the borrower and increase the risk proposition for the investor, but that would still allow the capital to flow.
So how does it work? If I understood, you have kind of a unique mortgage instrument or product or structure that you use.
So it essentially looks like a mortgage in terms of the legal documentation, but the couple of things that are unique about it are that we provide 100% of the funding to buy the houses, that we have a charge over the houses that are purchased with the money we provide, but not over the wider activities of the organisation, that our return, our interest, is performance-based, so we don't have a fixed level of interest. We look at the rental income of the property portfolio, deduct agreed costs with the charity, and then we receive the balance. So every quarter it's a different amount based on the performance of the portfolio, of the charity and of the houses themselves. And then the final significant difference is at the end of 10 years, what the charity owes us is a percentage of the value of the properties in the future as opposed to a fixed amount. So if they borrow £1 million from us, in 10 years' time, what they owe us back is 85% of the value of the properties, regardless of whether that's more or less than what they borrowed from us.
Yeah.
So they operate the houses for 10 years and they're guaranteed an equity position in the properties at the end of the 10 years. And at that point, they can use that equity to then go and get a commercial mortgage and buy the properties.
What is the equity position they end up with?
So they end up with a 15% stake in the portfolio, regardless of the valuation of the portfolio. If they buy £1 million of houses and in 10 years' time those houses are still worth £1 million, they only have to pay us back £850,000. So they basically earn their way into an equity position in the housing. Now, obviously, our assumption is, and it's with UK property, it's proven to be the case, the worst performing 10 years in history is an increase of 1.4% a year. So if the maths is right, in 10 years' time, these houses will be worth more than they were paid for them. And so the discount gets the fund back slightly more than was lent at the beginning of the life of the transaction. And the fund overall says, on average across the UK, we're going to see a continuation of steadily rising house prices, so that on a fund level, the money we get paid back at the end will be more than we lent at the beginning. But what it does do for the individual charities in each little geography and each individual transaction, they are insulated from being in a negative equity situation, which is what they're really worried about.
But how do you actually select an investment and make your investment decision?
We're looking for a couple of really key things, actually. I think the first is we're looking for organisations of a certain size. So we're typically looking for organisations with revenue of between £1 and £30 million, because this is from an impact perspective where we think our money can create the most social impact. We, like any investor, we look for really high-performing management teams and really great boards. That's really critical to making social investments. We look for organisations that have experience of managing, so we understand they're on a journey and we're part of that journey, but we need to be able to see a track record of how an organisation manages housing stock, because that's the bet that we're taking, really. We really importantly need to understand that they're a partner to their local commissioners, i.e. local government. We reference check with ultimately the organisation that's going to be the purchaser of their service. And we really need to understand that there's a close trusting relationship between them and that local commissioner. And we need to really make ourselves comfortable that actually the provision of housing is going to generate better social outcomes for people. So it's really just evidencing that impact.
All right. So then can you give me like one real world example of the type of impact and financial result that,
so I can tell you the organisation, the interesting thing about this product is we didn't sit in a room with a whiteboard and a bunch of really smart finance people and come up with it. This structure was genuinely co-designed with a charity without whom we wouldn't have landed on the structure. And that organisation is called Hull Women's Network. They're in Hull, in the northeast of England. And we met them quite early on in our journey, and their story was really clear. So they, at the time we met them, they had 99 properties that they managed in the Hull area. They helped women and their children fleeing domestic violence. The statistic they quoted was that women on average flee a violent perpetrator on 7 occasions and return before they finally break free. What they could demonstrate was that by providing an appropriate safe house, women left on the first occasion and never returned to the violent perpetrator. So you basically, I think we don't need to describe that social impact any more than that. Pretty evident. We were completely blown away by that just providing the right kind of housing meant that women and children could avoid 6 return visits to a violent perpetrator who may actually ultimately kill. And so we said, that's great. Why don't you have more housing? And they said, because we don't have the financial risk appetite to take on more, because ultimately our goal is to stay in business. And if we take on a lot more housing using conventional structures, we run the risk of not being around at all. So we accept a much slower rate of growth because we must endure, we must always be here. And that's how we got into the discussion with them about there must be a product that would make it possible for you to grow. They had 300 women on the waiting list that were trying to flee violent partners. There wasn't a way of growing their portfolio such that they could help those women. Since that time we met that organisation in 2017, with our funding, they have bought somewhere between 80 and 100 houses, which they now help women flee domestic abuse on a regular basis. And there's a never-ending list of stories of women and children who have been able to rebuild their lives after sometimes many years of misery and pain.
What's the total AUM in your housing fund?
So this fund is at 75 million, the first one.
Yeah, okay.
Which is, which actually, to be honest, not only is that extremely large in the social investment world, actually, if you look at the comparable world for us, which is small private venture debt part of the market, is actually in line with a lot of commercial funds as well. It's not out of place to a green bond fund or to a big listed equity fund that isn't large, but it isn't out of place. There are plenty of asset managers in the UK doing fully commercial business with funds in that zip code. Our next fund in the housing space is going to be 150 to 200. So for us as an organisation, we are short-term goal of 250 AUM, medium-term goal of 500.
What would you say the benefits are to your investors?
This is really the real trick with impact investment, is that the benefits to investors have always been the same. It's the ability to make a fair return doing something you can be proud of. The truth is, 3-5 years ago, there were lots of people who believed that was the right thing to do, but there were a small group of people who felt they actually could do that, whether it's because of their mandate or because of the fiduciary responsibility, etc., etc. There was only a small group of people who felt that they could say, this is the right way to make an appropriate return, so we're going to do it. What's changed over the last 2 to 3 years, beyond recognition, is that not only do people recognise the importance of putting some of their money to work in something that generates something other than a pure financial return. Actually, I'd say that many investing bodies are actually nervous about not being able to say what it is in their portfolio that is doing that. So we are finding that people are either pushing themselves to understand what is available in the world of impact investment at our end of the spectrum, or in some cases, their stakeholders are pushing them quite hard towards us. Well, I can tell you there are asset managers in the UK that manage the large sums of money that sit in charitable endowments, where the charitable endowments are saying to the asset managers, what exactly are you doing with your AUM that is socially impactful? And some of those asset managers may be losing mandates because they can't describe what it is that they do that's impactful. When you lose a mandate, you can put a very clear number on what it just cost you to not be doing something more impactful. And that is definitely helping organisations consider the best way for them to do impact investment in the UK. So I would say that if you look at the journey of SASC, for many years, there was an absolute bar that we as an organisation needed to get over to be able to attract commercial money. And that absolute bar was too high because of the nature of what we did. What's happened now is that's rather become a relative bar. Organisations are saying, we need to do something in the impact social investment space. What's the best fund available? So we've gone from having to reach some artificially high bar to now just having to be the best product on offer. And not everybody agrees, but there's enough people that believe that our product is the best thing on offer. And as a result, we're engaging a far broader range of investors than we would have thought possible.
You've described all the benefits to investors. Primarily, the revenue seems to be coming ultimately from the government. Yep. You've described the impact that nobody could argue with and everyone would want to be part of, and you're benchmarking somewhere in the high single digits, 5 to 8%. So this sounds like an investor win-win wonderland. Is there any downside to this?
The downside is we're a small asset manager that started running money in 2014. Ultimately, for some people, it's a challenging area because we're funding organisations that are working with vulnerable people. The funds are very long dated and they're completely illiquid. You invest in 2021 and you don't get your money back to 2032 and there's no liquidity. I think actually people would have said the risk profile of housing benefit, this is pre-COVID, they would have said, oh, the risk profile of housing benefit is tricky because governments cut spending, etc., through COVID. It's the only area of the property market that you have not been absolutely, crushed in, because if you're investing in housing or in commercial property or hotels or shopping centres, obviously you've had a torrid time.
There seems to be some kind of a natural tension between delivering a financial return to investors on one side and then you're deploying capital to companies that have real urgent human needs.
Yep.
Is that something that you have to manage in a certain way?
And that's the secret sauce, if there is a secret sauce for SASC and any other organisation in this space, is being credible to both sides of this problem. Right? So we, I think, somewhat uniquely have two stakeholder groups that are very different. Right? So if you're a venture capital business, you're talking to investors and founders who are both trying to make a lot of money and everyone's on the same page and it's really straightforward. We, as an organisation, have to be able to engage with organisations that are motivated almost entirely by purpose and in some cases may even find profit quite a challenging concept. And on the other side, we're working with investors who are increasingly interested in purpose, but ultimately, when it comes down to it, there's an underlying financial incentive, and that's tricky. And it's quite a hard place to live in that grey area of impact and between purpose and profit. And I think that's what we do well. It's constantly reassessing the construction of the product, how we market, who we market to, who we engage with, who we work with. It's hard. Sometimes we say, who knew how hard it was going to be to try and do a little bit of good. We aren't delivering the social outcomes. We're supporting organisations that are doing the hard work. To be clear, we're in a supporting role. We don't claim the impact of the organisations that we provide finance for. But it's been surprisingly hard to create a sustainable asset manager in this space because it isn't something that, left to its own devices, capitalism probably would have found. As you say, it's an interesting clash of cultures.
You originally were funded by charities or charitable organizations who probably weren't interested as much in a commercial return, but it sounded like you're getting more, perhaps pension funds or other organizations that clearly have a fiduciary responsibility, but maybe because now they have to report on the impact that their investment activities are having, are interested perhaps in you, but at the same time, they have a fiduciary responsibility on a return on the assets that they're managing. Has this changed by a big percentage for you?
2-3 years ago, it was hard to see. We've been going for 4 or 5 years, and it wasn't clear how we were ever going to make the change away from that small group of highly motivated investors that would allow us to do what we were doing, but ultimately could never provide the scale of capital that would allow us to do things in a meaningful way. And then it all changed when the investing world discovered impact. And whereas, as you say, ultimately, the truth is, 3 years ago, it was very hard to speak to an organisation with £1 billion fund and persuade them to part with £5 million into something like us. Now, the argument is, I've got £1 billion, it's just a £5 million investment, and it's really what we need to satisfy people that we're thinking about the way we invest. The whole argument's been turned on its head. It's gone from being too small to be relevant to very relevant and helpful, that ultimately it's a small percentage of people's financial exposure. It's been a sea change. I think initially we thought it was a threat because we thought, I think there still is this risk. If people don't understand the difference between green bonds and what we do, organisations may have a small portfolio of green bonds and say, that's it, that's my impact investment done. But actually, I think that initial fear has gone away, because I think actually people really do recognise the difference between an organisation issuing a green bond and providing capital to an organisation that helps women flee violence. I think people do understand that. And it may be that the investor understands it, but says, I understand the difference, but I cannot do what you're doing for reasons X, Y, and Z. Yeah. But that is still positive.
Could you paint the big picture, or give me a big picture overview of what the community investing space looks like for someone who doesn't really know it, and then where does Calvert fit into the overall space?
Yeah, so if you think about, in general, what we invest in, what the community investment space invests in, is investable opportunities that traditional banks don't do. So this is what JP Morgan doesn't do. Affordable housing projects, microfinance loans, renewable energy that's new and novel, rural communities, Black-owned businesses. There's something about each of these transactions where the perceived risk is higher than the real risk. And because we work close to these communities, we understand these markets, and we have increased comfort investing in these businesses or these projects, so we see a different risk profile. And so to move the money into communities, what we have found is there's a whole bunch of private capital over here, that there's a set of community intermediaries that are working with that private capital. They're offering them products and services and education to invest their money in another set of intermediaries that are community-facing intermediaries. These are microfinance institutions, affordable housing developers, community development, small business lenders. They sit in communities, they sit close to the projects. And a whole bunch of us that sit here, like Blue Orchard, like Responsibility, like Calvert Impact Capital, we're raising money from investors and investing it in these intermediaries and impact funds that are sector or geographically specialized, and they are finally on lending it to businesses and projects in place. Unlike traditional finance, there's a lot of intermediation to move this capital into the community.
All right, so are you very similar to Blue Orchard, for example?
Yeah, we sit much closer to Blue Orchard, to a Responsibility. We are creating investment products to bring private capital into impact investments. But we are not making a direct business loan. We are not investing directly in affordable housing project. We are investing in intermediaries that then lend to the business, to the project, to the person in place.
Where do you fit in, and then what is there a difference between you and the other players? So who are the big players that are similar to you, and then how are you not similar?
A few things about who similar to and where we sit. This little silo we're talking about, the Blue Orchards, the Responsibilities of Calvert Impact Capital, what we're doing is we're structuring products that meet investor demands, right? They have demands around liquidity, around risk diversification, right? No investor wants to have a direct investment of $5 million in Tanzania, right? Investors want an investment that's 5 years or shorter. However, many community investments are 10, 20, 30 years in duration. So we're solving for that problem. size. An institutional investor, they don't want to make an investment less than 10 million. So you need product that has enough size that they can take a meaningful piece of it. So we're solving this problem by aggregating, structuring a product that really meets those investor demands. And yes, someone like Blue Orchard is doing something similar. Us, responsibility. And then the list gets very thin. This is where we don't have a lot of actors. And to me, this is one of your questions. What is the most challenging problem in the impact investing space? It is this. We don't have a lot of good ways for mass affluent, for advised assets, right? A CIO that oversees a pension fund or a financial advisor that oversees a high net worth individual's client portfolio to really invest and engage in impact investments unless they take the time to underwrite and do diligence a direct investment themselves, which many people don't have the time, the capacity, nor the fiduciary bandwidth to do. So this is a thin piece of the market. And more, even though I would say we're a peer with Blue Orchard Responsibility, they design their products for European regulations. We're overseen by the SEC in the States and the US, and we raise US capital. So we're similar to different audiences. And so if you look in the United States, there's other players that issue community investment notes. No one's as big, no one is as established as we are. We have distribution into the large wirehouses, so we're wired in the walls. So a financial advisor can go to the Merrill Lynch platform, find our note and put it in client portfolio and have it electronically. It trades at par, there's daily liquidity, so mutual funds can buy us. That whole distribution feature is very unique to us. Many other community investment notes just sell it directly to investors, right? You fill out a paper form and mail in a check. So it doesn't have wide access for investors. There's some other, Equilibrium is a private equity fund, as well as they have some debt vehicles. There's something called, there's other funds like Jonathan Rose in the United States. He has an affordable housing development fund. But all these other products are for accredited investors only, or qualified investors. They're LPGP funds, so often they're PE, so they fit into the alternative asset class. There's very few other products that fit into the fixed income or into a cash alternative bucket. So it's a growing space, but there's still a very thin product selection. And it's where it's just it's hindering money to easily flow out of client portfolios into true investments.
You are accessible directly retail, right?
Correct. You can go online and buy a note for as low as $20.
And I don't think Blue Orchard is.
No, they aren't.
Okay, so I got it now. But what people want to know is, what are professionals like you doing? And we understand the high level what you're doing, but people want to know, so really, how are you doing it? How are you deploying capital?
Yep.
Yeah. So what happens when you start making the sausage? Okay.
So when we start making the sausage, as you said, we have a retail investor base. So our risk tolerance needs to respect a retail investor. So we're quite low risk.
Okay.
We aim to have a diversified portfolio across sectors and across geographies to minimize that risk. And we look to intermediaries, both because operationally we're all in Washington, D.C. We're not in the field. So making a direct loan in Tanzania or in South Africa it's a riskier proposition. It doesn't align with our risk profile. So we lend to intermediaries.
You don't have any offices anywhere outside of?
Nope,
okay.
This is it. And we travel a lot, but this is it. And that's our theory of change too, is that if we can create impact funds, financial institutions in communities where there's not good access to capital, if we can capitalize them, then that's a sustainable reliable capital source for those businesses in place.
Can you give me an example just one example that ideally captures your strategy in terms of someone invests in you and then you take that money and then what was the impact both from a financial perspective and then from an impact perspective?
So we lend into 9 impact sectors. So just as a headline, we have a different theory of change for each of those sectors. Small business, affordable housing, renewable energy, etc. An investor can target their money to any of those sectors or untargeted, so they just support the whole portfolio. And so a very typical investment for us would be in Africa. There is a group called Sun Funder. They are headquartered in Kenya in Nairobi, and they work across the African continent providing businesses that provide pay-as-you-go solar capital to expand and grow. And so they're putting solar home units on individual homes that are not connected to the grid and providing solar power to hundreds of millions of people. That business model, pay-as-you-go, where an individual leases to own a solar panel, was a business model that none of the banks in Africa felt comfortable investing in. And so Sun Funder is a new fund manager that emerged probably about 8 to 10 years ago now to do that type of lending because none of the banks would do it. We were one of their first investors. We were a debt investor in a blended finance vehicle, so there was equity and other investors beneath our investment. And they've lent that money out and helped grow that renewable energy sector, the pay-as-you-go sector in Africa. Fast forward now, there's other Sun Funders across Africa, right? Other impact intermediaries doing the same type of work. The development finance institutions have heavily helped grow and scale this field. And now Standard Bank and other banks are starting to lend to these social enterprises, these businesses that are providing the pay-as-you-go. So what Sun Funder did is they demonstrated that these were investable assets. They built a track record, and then they went out and was able to share that with more traditional finance capital sources that could scale and grow the sector. And so we have about 70 million of exposure to sub-Saharan Africa, solar renewable energy. And we probably won't do much more because we've been in there as an early investor, used our capital that demonstrates investable, crowded in a lot of DFI money, and now the traditional banks are coming in because they're comfortable with that asset. And to us, that's victory. Then we can move on to a new asset that people don't understand or where the economics don't make sense to them because, again, they think the risk is much higher than the real risk that we see. And so we'll take a much lower return for those investments and build a track record in those assets as well, and hopefully pass them off as well. Some pass off, some don't, right? It's taken 30 years for microfinance to grow and scale and access capital markets. It's taken renewable energy in sub-Saharan Africa a decade. Sustainable agriculture is still a broken market in some places. So these are long-term. This is a marathon, not a sprint, but that's what our portfolio is doing.
So when you invest in Sun Funder, is that a
Yes.
debt instrument? Is that equity? What is it?
It's a debt instrument.
Okay.
There was equity beneath us in the instrument as well, but our investment was debt.
And you only do debt? Is that?
We have a few equity investments, but this goes back to just the profile of our investor being retail, so needing to keep our risk low.
So I guess the devil's always in the details, and it sounds like your model all depends on you working through MFIs or community development financial institutions, because you can't do this all direct, right?
No, and there's these intermediaries exist in all the different sectors. And so, you know, it's hard to say what a typical transaction is because that intermediary lending. The type of investment we're making is consistent, but the shape, form, and structure is it varies. So like we were the first investor in the Seychelles Blue Bond. That was issued by the government of the Seychelles. So it's a general obligation of Seychelles, it's sovereign debt. But it couldn't float in the capital markets because it was only $15 million. So this was not going to hit any sovereign desk. It was too small, and the yield they wanted for the risk of the rating did not align. And so us and two other institutional investors took that down. So, the blue bond, we have a sovereign blue bond in our portfolio that doesn't look structurally like some funder, but it's doing the same thing. This was the world's first blue bond. Someone needed to take the risk and demonstrate that it was investable, and we did that.
Okay, yeah, before we get too much further, we keep hitting on this. I want to get it out on the table here, this community investment note. What is it and how does it work?
That's our center of gravity right now. It is our flagship product. It's a fixed income product. It looks like a corporate bond. We sell it in 1, 3, 5, and 10-year increments for rates right now of 0.4% to 2.5%. You can access the community investment note 3 ways. One is online. You can buy a note for $20. You can buy it through your brokerage account. So you can go on the Schwab or the Fidelity platform and for $1,000 minimum, buy a note. Or you can just directly write us a check. And we have a track record of 100% repayment of principal and interest over the 25 years that we've been issuing the note. And the growth of the note has been exponential. It's 600 million, outstanding balance now. In 2017, it was 350 million. If you go back, it was smaller and smaller. We're always in the market raising capital, as I mentioned, always in the market deploying capital. So there's a sales team here of 4 people, 5. That go out, they work with financial advisors, they work with institutions, they educate them about impact investing and our note.
I've read that somewhere that your historical repayment rate is 99%, but investor repayment is 100%. So where's that 1% spread?
Go, yeah.
Where's it come from?
It's a great question. So when I say it's like a corporate bond, that's because they're buying our balance sheet, right? An investor is investing in the balance sheet of Calvert Impact Capital. 80% of the senior debt is the note, and then there's 20% of subordinated debt and equity beneath them, net assets. And so we have that buildup of net assets and subordinated debt where if we have losses, we can absorb that loss and it not impact the senior note holders.
Okay.
And that gives them great comfort. So when someone considers buying the note, it looks like a corporate bond. It has a QSIP. It trades at par. And they look at the track record of our portfolio, the diversification. They look at the subordinate capital beneath them, and they get comfortable with that risk profile.
Do you feel that these are risk-adjusted returns?
The money in or the money out?
The coupons you're paying because you are operating in what some people might refer to as funny places.
I do, because of our track record of 100% repayment over 25 years, because of the subordination beneath that senior note offering, because of the track record of repayment on our portfolio. I feel like we've demonstrated that we're operating in funky places, but that they're investable assets and that we are built for purpose. So the team that's doing this work understands these markets, understands the people we're lending to. We have a rigorous due diligence process, and that's all really important in being fiduciaries of their capital.
Now, I think you might have hit on this before, but I think you have 3 main strategies: balance sheet loans, structured debt, and asset-backed facilities. Is that correct?
So that's more just the products we offer. We can do anything. We have a bucket too when we report to our board that's called other. So that's more of a way we just look at our portfolio through a lens of risk. We divide it by what geographies that it's in, what type of products we're offering. Our strategy is build, grow, sustain. And it's really looking at new, growing, or sustaining intermediaries and providing them the capital so that they can grow and scale.
And do you use blended finance?
Everywhere. Everywhere.
Yeah.
Every transaction has a piece of blended finance in it. Every single one.
Okay, and so I mentioned before that all of this depends on your intermediary network. How do you do due diligence?
It is a rigorous process. We have 2 credit committees. One is a staff investment committee, another is a board investment committee. And we bring due diligence memos to these committees. The due diligence memo is extremely thorough. It's looking at both impact, capacity to repay, the character, the risks and mitigants. There's a pricing model because we do risk-based pricing, and there's a risk analysis that's based on ELR, probability of default modeling. And so it's extremely comprehensive. And we also then, once we make our investment, if it's approved, we do quarterly monitoring, both impact and financial. We do annual monitoring, and we have a very robust process to manage impaired assets. So a classified assets, an actively monitored list. We always visit our clients. We do due diligence site visits when we underwrite them. It's been a little difficult in COVID. And we also travel and meet them at conferences. We talk to them on the phone. Many of our investments, if it makes sense, right, if it's not a closed-end fund, we renew and grow our relationship over time. So there's some partners we've had in our book for 20 years. And we have grown our investment as they have grown.
And I imagine you're working mostly in developing countries.
Correct.
And I know personally, I've spent a lot of my career living and working in some of these places. And a lot of these are places where the rule of law is, let's say, isn't always the rule. And when there's money involved, there's often corruption, and sometimes on an industrial scale. So how do you vet your MFIs and your intermediaries? Because some of these places, they're professional and they practice on each other.
It's a great question. There's a number of strategies. One, we hedge everything. So if you think about the risk of local currency lending, because we do lend in local currency. If we do any local currency lending in our book, it's hedged. So we don't take currency risk. We also have a country risk model where we've looked and created a framework to divide the globe into A, B, C, and D countries, D being the riskiest, A being the strongest. And we've set limits on how much exposure we can have in any of those countries, very much correlated to their country risk score. So we have that framework. When we underwrite an individual credit, 2 things come into play. Often, a fund manager is working across multiple countries. So that helps to mitigate the risk. Yeah. And oftentimes with these funds, we'll negotiate country or geographic exposures. So limiting investments in South Africa to 25% of the proceeds they raise, et cetera, and us and the other lenders. So this is not just us, this is the LPs collectively. There is negotiations just around country risk limits for these investments we're making. And then finally, we look at features in our risk scoring model around political stability, ability to get repay, strength of the rule of law, things like this.
Could you just start with an overview of LeapFrog? You've hinted at what the origins are, but I think it's expanded beyond that. What the mission is, maybe start at the 10,000 meter level and then
zone in a bit. Yeah. So the best way to understand LeapFrog, we see ourselves as one of the world's leading impact investment firms and define impact investing as profit with purpose. So this is a fully commercial activity. We don't believe in trade-offs at all. We believe that it's possible to build big businesses that are serving low-income people, helping low-income people to get access to the services they need. At the same time, build big organizations and make money for investors. So our theory of change, if you like, is around really just that, providing emerging services to what we call emerging consumers. So it's all about the idea that if you look at poverty, what is really happening there, you have a large group of low-income people who don't have access to healthcare, to financial services, insurance, payments, etc. And if we can help low-income people get access to these essential services that everybody else in the world just takes for granted, that will reduce poverty and help to lift that group up towards the middle class. And that's where we get both our profit from, because we're building businesses that do that, and our purpose from, because there's so much social good that you can do by providing these services to people. So that kind of in a nutshell is the theory of change at LeapFrog. Essential services for low-income people and getting both profit and purpose from that.
By regionally focused on Africa and Southeast Asia, those are the only two regions you focus on.
So for us, a really important theme has always been scale. We were never very interested in the idea of funding projects where you could help 1,000 people or even 10,000 people. We always thought about, how can we invest in businesses that are helping to lift millions of people out of poverty? And if you want to do that, you need to think about the markets where there are large numbers of low-income people. And for us, there's kind of three clusters. There's Southeast Asia, where we're very active in places like Vietnam, Philippines, Indonesia. And then you have South Asia, where India is our single biggest market. That accounts for about a third of our portfolio. And then finally, Sub-Saharan Africa, where we're very active. But we're not, we're certainly not global. We're not in China or like in Latin America. We're just very intentional about these handful of large low-income markets that we invest in across Asia and Africa.
You just mentioned India. I've worked in a lot of these places. How does it work to invest in India? Because the problem there is always getting your money out of there. Could you summarize how you're investing there?
Yeah, so we invest in a bunch of different things in India, including insurance businesses that insure low-income people, lots of lending businesses who are trying to do loans not dissimilar to some of the micro lenders, that kind of strategy. We've even done some stuff in healthcare now, also in technology. Of course, none of these countries are easy places to do business. There's reasons why people that invest there seek high returns. But oddly enough, we've never had a really difficult exit challenge in India. Reason being that actually most of the time investors are pretty excited about India just because the total addressable market in India is always absolutely massive and the growth potential is always enormous. And I think in a funny way, we are quite fortunate that, strategic investors who are largely oriented in, say, Western markets or maybe in Japan, are kind of sat there in sectors like insurance and healthcare saying, oh my goodness, where is the growth going to come from? And, the answer to that, I think, is perhaps partly now in changes in technology, but I think a big part of it is countries like India. If you're running an insurance company today, it's going to be very tough to grow in Germany or the UK, but India is always an exciting growth opportunity. So we've done quite well usually by selling our investments in India to strategic investors who want to take the business on to the next stage.
So you've focused on Southeast Asia and Africa because of the large numbers for scale. What about financial services? I guess that was the initial focus.
And it sounds like that's expanded beyond the insurance. And later on, you got into healthcare. Could you maybe speak on?
Yeah, sure. So we started in insurance, and I think this played out very well. Was insurance penetration was very low in all of these countries, and yet the people that lived there lived very risky, very vulnerable lives where, people were constantly suffering and kind of slipping backwards economically because of adverse health events, or maybe the father of the family or the mother dies, or maybe they have like a key livelihood asset that goes missing. So, but nobody had any way to formally protect themselves against those kind of risks. So the first fund was all about just really that theory of how can we help the insurance sector to expand and serve more low-income people and help to protect them against those risks. And we had all sorts of success stories with that. I included, a health product that we did with a company called Mahindra that reached 2 million people. We had a company we invested with called Bima, which I think sold something like 30 million policies in the period that we were invested there. That was completely digital, which is the reason they were able to scale so fast. And then in our second fund, we said, well, that's worked really well. How do we take this into other areas of financial services? So we started investing in credit businesses, and we invested in a few what are known as NBFCs in India, as well as across Africa. And then finally, in our third fund, we expanded that again to include healthcare, which was a natural adjacency to the health insurance expertise that we already had. But even today, although we have expanded from where we were in terms of just being in insurance, right now we're in financial services and healthcare, and that's it. We don't do anything else. We've never been about, investing in every kind of impactful business we can think of. So we're not impact generalists. We're very specialized around, okay, we know how to do financial services, we know how to do healthcare, and that's it. We don't go outside of those tramlines. So it's still very carefully defined what we're doing and very intentional.
How many funds do you have?
4 funds. We have 3 kind of standard, typical GPLP sort of private equity style funds. And then we have 1 separate managed account, which is with Prudential, the US Prudential, who put some money into a vehicle that we use to invest just in life insurance in Africa.
These are closed-ended funds that you have?
All closed-ended funds. The original idea was that when LeapFrog was first started, we wanted the funds to be as close to standard as possible, because at that time, the whole impact investing story was so new and so different that we didn't want to have too many wacky things in the structure. So we just went for a vanilla private equity structure. Yeah.
And from the get-go, you were in both Africa and Southeast Asia?
And South Asia, yeah. So Africa and Asia from the beginning.
Okay.
Yeah.
So the funds have no regional focus. They're covering both of those. The first fund was much more insurance focused. Is that right?
Yeah, that's right.
Yeah. How did Andy, what was the genesis of him focusing on this and starting LeapFrog?
Well, yeah, he'd had a few, I suppose, formative experiences. He was at Ashoka, and I think he'd had some sort of induction with the general notion of social impact investing. He'd worked with a lot of social entrepreneurs, etc. But I think, if you were to ask him what was the genesis of how he began LeapFrog, he worked for a poverty economist called Amartya Sen at Trinity College. And he did a project during that period around trying to sell irrigation equipment to farmers in Rajasthan. And he had a hell of a tough time doing it because basically trying to flog this irrigation kit to farmers, and he'd say to them, there's a 90% chance this thing worked, and he couldn't make any sales. And he found that just baffling. Why do these guys not want to buy this irrigation equipment? 90% chance of success or whatever it was. And what he started to realize is that these relatively low-income farmers could not take any risk, because the problem they had is the 10% chance was such a severe downside for them. If they, if the irrigation didn't work, then they'd spend all that money, and then, they were really going to be in trouble. And he realized that, that inability to manage risk was just so critical to life. And that was really what got him into the insurance sector, and kind of, working to try and develop the insurance sector in a way that it protected more people and allowed people to actually take the risks they needed to do to improve their lives.
What your average ticket size? I'm just trying to make sure I cover the base here.
Yeah, so right now, anywhere between 10 and 70 million US dollars. Our most recent fund, for example, was $740 million.
And AUM, is that something you publish?
Yep, so about $2 billion at this point.
Right. And then what do you benchmark these funds against?
Well, for us, the critical thing is that, as I say, we're completely commercial in our orientation. We don't believe in trade-offs. So we benchmark ourselves against, the private equity peer group. We see no good reason why we should be underperforming our private equity peers just because we're doing impact. In fact, we think if anything, it enhances returns. Yeah. So that's how we benchmark ourselves.
I'd like to try to see if we can drill down into your investment strategy. How do you actually select an investment and make your investment decisions logistically, tactically, operationally? How does LeapFrog deploy capital?
So I think the first thing to say is that everybody who works at LeapFrog is very specialized in terms of country and market. So, I spend most of my time on India. There are, a number of other people in the team who do the same. There are others now who are based in Nigeria or Kenya or whatever it may be. And everybody's either a financial services specialist or a healthcare specialist. So all of the investment people are very, very close to their sectors and their markets, to spend all their time there, et cetera, et cetera, et cetera. And they're so specialized that they just go around meeting CEOs of companies in that sector. That's all they do. Yeah. So they're very close to what is going on in these places. And so, very practically, the key to deployment is that kind of localism that you want, that we're very local and very specialist. I mean, there shouldn't be anybody in, for example, the Kenyan insurance industry who doesn't know the relevant person in LeapFrog for what they're doing. And then we just go around meeting CEOs all the time, figuring out what's going on. Sooner or later, all these companies, usually they're growing. So sooner or later, they have some sort of capital need. And then usually we'll try and have a proprietary conversation with them about whether we can be the provider of capital. We don't like auctions or participate. All private equity funds say that, but we really don't, we really don't like participating in auctions. We like to go and do proprietary things with people who we feel are kind of values aligned. And then in terms of how we make the decisions, typically, a partner will, or more often actually two partners will get together to look at a deal. We have an investment committee, which has effectively 3 stages that you have to go through to get approval. And to get that approval, the deal team will write up a long paper, which includes all of the usual stuff, of course, around the market and the company and the other shareholders and so on, the strategy of the business. But the really critical thing is it'll include a valuation section and a impact section that are equals in the decision-making process. So there's no trade-off. And this is not something where we're basically doing old-fashioned private equity and then just giving it some impact lipstick at the end. The impact analysis is just as serious as the financial analysis. And each investment has to meet both bars. So it has to be a good financial investment and it has to help us to reach our impact objectives, which at this point involve reaching millions of low-income people.
What are the screens that you have, both financial and non-financial?
So financially, we try and make what we refer to as top quartile private equity style returns. But essentially, the financial metric is standard private equity returns. And the impact metric is that we will set ourselves a goal for the number of low-income people we want to reach for each fund. So I think the latest fund is 100 million people. And then each investment has to make a material contribution towards that. So if I come along with an investment and say, hey, this thing's going to do 30% return, everyone will go, that's great. What's the impact metric? And if I say, well, unfortunately, it's only reaching 5,000 low-income, people will say, well, that's not good enough. That's not giving us a good enough impact profile towards our target of wanting to reach 100 million people. And so both are taken just as seriously and measured just as seriously.
You're working only in developing countries, and I know a bit about it personally, having spent a lot of my career living and working in a lot of these places. And a lot of these places are places where the rule of law isn't always the rule. And when there's money involved, then there's often corruption in some of these places on an industrial scale. How do you vet your targets before you make the investment? Then once you make the investment, how do you do ongoing due diligence once the company's in your portfolio so that things don't go pear-shaped after that?
Yeah, it's a good question. I think there are two answers to it. One is that, since the beginning of our first fund, we've always been well supported by the development finance institutions. So people like IFC and CDC and DEG and that group of organizations, DFC, now OPEC as it used to be known. And for that reason, all the anti-corruption sort of legal stuff, we've never had an inch. We've always been legally absolutely insistent on all of our companies operating to the highest possible standards. So when we do investment agreements with people, it is always essential that they sign up to a set of rules around issues like corruption and bribery and anti-money laundering, which are, very stringent. So legally, that's the answer. Now, of course, the problem with that is that if somebody was corrupt, would they really be put off by signing some bit of paper with a long list of, prohibitions? Who knows? But we talk a lot about partner selection, which means we try very hard to find businesses that are operating to world-class standards in terms of governance around these issues. So, and a good example of that is Mahindra Group, which was one of our first partners in India. We invested in their insurance business, which was a fantastic outcome for us, both financially and from an impact perspective. But I remember we met them maybe 2012. And around that time, The Economist had done a profile of Anand Mahindra, who is the kind of patriarch of the group, where it depicted him in the cartoon as a Jedi fighting against all these sort of corrupt government bureaucrats who are all in these kind of dark robes. I think that cartoon put it very well. That's who we want to find. We want to find the people in these countries where the governance is absolutely top-notch and they're not getting mixed up in the kinds of issues you talked about. And unfortunately, it means you have to walk away from a lot of stuff from time to time, but we've just always been zero tolerance.
Maybe you could give me one or two examples of investment that you think would capture your strategy, both from a financial and impact perspective. Take me through, how did you find them, or how did they come in your pipeline, and then how did you make the investment?
Sure. I mean, I'll give you a couple of examples. One that I guess people kind of like hearing about is a company called Bima, which is this mobile insurance business that we invested in 2013. And Bima, essentially what it did at the time was partner with mobile operators to sell insurance to their customer bases. And that was pretty exciting because, as you will know, whatever other limitations exist in emerging markets, the vast majority of the population have a mobile phone. Actually, today, it's even better than that. The majority of the population now pretty much have smartphones that they can use for different things. And the mobile operators are very dominant. They have incredible data that is very predictive and very easy to use. They have payment mechanisms that you can use easily to collect payment for the service that you're providing. They have fantastic brands, which really matters a lot in insurance. Insurance is all about trust. And many people in the developing world, their first experience of insurance will very often have been, being scammed by somebody who said they were going to provide protection against something. So Bima had developed this means of partnering with mobile operators and selling life and health insurance to their customer bases. And this thing grew incredibly quickly. When we first invested in them, they had $1 million of revenue. By the time we exited, it was $30 million of revenue. And they'd gone from, I think, maybe 3 or 4 markets to being present in 9 markets across Ghana, Tanzania, Bangladesh, Indonesia, Sri Lanka, a lot of big places. So that did incredibly well for us. And at the same time, because they were using all of this mobile infrastructure, they brought the cost of providing insurance down to, $1 a month, if that, sometimes actually less than that, for covers of, a few $1,000s. And I think something like 80% of the Bima customer base had never had insurance before. And certainly the health insurance piece was incredibly new to the customer base. So that did incredibly well for us. And eventually, back in, I think, 2018, we ended up getting an approach from Allianz and sold our shareholding to Allianz. And for them, there were 3 things, really. First of all, they were fascinated by this company that was selling insurance digitally and doing so successfully and scaling quickly. And they felt there would be a lot of lessons for the core business. Secondly, the impact story was also incredible. I mean, the business, I think, had reached 30 million low-income customers over, the period that LeapFrog had been invested. And then finally, just a lot of growth. And, Allianz were sitting there very worried about digital disruption, very worried about finding growth in Germany and in other markets. And so then this was really an appealing prospect to buy into a company that's growing quickly.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.